It's very easy not to think about our pension when we're young, but by the time we get to 45, 50, 55, then we want a clear plan in place. And that is the case whether you are declaring a low income or whether you're declaring quite a high income and you would like to improve your retirement but at the same time reduce your income tax bill. This video has something for both of you. Welcome back to this channel where we demystify business in France. Today we're talking about retirement and looking at the way things are going. This is something that all of us are going to have to take more personal responsibility for. So let's start off by looking at the minimum requirements to validate a pension. In 2024, to validate a full year's pension rights, you need to declare income of at least 6,990 euros. We can round that up to 7,000 euros to make it easier. Now, if you're a micro, then this figure is after the abattement that the tax office allows you for expenses. So if you're a micro BNC, that would be like a coach, a teacher, a consultant, then this 7,000 euros needs to represent 66% of your income because you get that 34% abattement. So you need to be declaring a minimum turnover of around 11,000 euros to validate a full year's pension rights. If you're a micro BIC, that would be a tradesperson, for example, then you have a 50% abattement. So to validate a full year's pension rights, you need to be declaring a minimum turnover of nearly 14,000 euros. And if you're a commercial micro, well, you have an abattement of 71%, which means that to validate a full year's pension rights, you need to be declaring a minimum turnover of around 25,000 euros. If you've been declaring less than that, and obviously the figures do go up over time, but if you've been declaring significantly less than that for a number of years, then there is now a hole in your pension. You will have validated a partial amount for your pension, but not a full year every year. You're going to have quarters missing there, so you have some catching up to do. Now, to my mind, this is one of the big pitfalls of the micro. You can be paying around 20% of your turnover in social charges and still find that you have not paid enough for an adequate level of social protection. We talked about this a little bit already in this video. So if you've been earning the money but not declaring it, I think you all know what I'm saying, then you can start declaring it. Just make sure that what you put on your tax return matches up with what you declare to URSSAF, and that's one way to go. But if this hole in your pension has been going on for too long now, and you have some serious catching up to do, well, then you need a pension plan. And now we need to talk to the other people who are declaring maybe 60,000 of your income or upwards each year. You have an income tax bill that you would like to reduce. Well, you guys also need a pension plan. Why? Because your contributions to it are tax deductible up to a certain threshold, but that threshold is quite generous. There are lots of pension plans, but today we're only talking about the Plan Épargne Retraite Individuel, the PER-IN, sometimes still known by its old name of the Contrat Madelin. And we're talking about this one because it's open to everybody, regardless of age and regardless of employment status. There are other pension plans that are way more advantageous. We mentioned them in this video, and they're open to you if you have at least one employee. Could be a part-time employee, could be an apprentice, but for this the way it works is very simple. You put the money in, you block it until your retirement, although in some circumstances it is possible to unblock it before your retirement. The money is invested, it grows interest, and when you reach retirement, then you unblock that money either as a lump sum or in regular payments or as a mixture of the two. Does it sound too easy? We can break it down a bit more. Traditionally, either through a bank or through an insurance company, but these days nearly all of them are sold online. Well, you look up some of the comparisons that are already available. Type in a Google search, Meilleur per 2024, and you'll see that a lot of that hard work has already been done for you. Make sure that you are reading a truly impartial comparison and that you're not just looking at a sponsored post that wants to sell you a particular product. Obviously, you'll be looking at past performances, but also management fees, transfer options, and diversity of investments are important criteria to take notice of. Well, you have a choice between effectively taking out a life insurance policy or instructing your per provider to invest your money for you. Now, they will invest it in a number of different things. Could be property funds, could be ecologically friendly projects, could be bonds. But the point is that the closer you are to retirement, the less risk they will take with your investment. And the further away you are from retirement, the more of a risk spread they will factor into your investments. All PERS are affected by wider market conditions, so when one goes down, they all go down. As an example, in 2023, the average performance was 5.5%, whereas in 2021, the average performance was 10.5%, so they're pretty good rates. What you want to do is keep an eye out for PERS that stand out as better performance, even bearing in mind the wider market conditions. So every year, your PER provider will keep you updated with information on your investments and their performance. They'll tell you exactly how much money you have this year. They'll give you a comparison as to how much you had at this point last year. And they'll also let you know of any changes that are going to come into place regarding fees or conditions or any new funds that they're going to be offering. No, you don't. You put in what you can, when you can, and if there happens to be 1 year where you can't put in very much, then you can even stop your allowance until the following year and put in more then. Taxation of PERS is extremely complicated and we would need a very long and very boring video to cover it properly. But basically, you can either take your tax advantage at the beginning when you put the money in, or at the end when you take the money out. You can't have both, but you can choose the one which suits you best. Let's say that you fall below the income tax threshold, so you don't actually pay any tax. Well, there's no point in you claiming the tax deductibility when you block the money. You wouldn't have any tax to pay in any case. So what you will do is you'll stash away whatever you can, and then when you unblock the money, you'll claim your tax advantage then once your gains become available to you. If you do pay income tax and you want to reduce your income tax bill, then the first thing you need to do is check your tax deductible threshold. Everybody's different because it depends entirely on the total income and the composition of your household. So you will check on your most recent avis d'imposition in the information complémentaire at the end, and however much you block in your PER up to that threshold will be tax deductible from this year's income. Now, you may choose to make the PER contributions out of the salary that you pay yourself, or you may choose to make the PER contributions a business expense. And your accountant should do a simulation for you to best optimize that. And I'll just say very quickly that with dogs, that's all part of the service. You're using your tax advantage when you block the money. And what that means is that when you unblock the money, you'll be liable for income tax. And also, let's not forget CSG, currently charged at 17.2%. We never get away from it. But let's not forget that when you unblock this money, you will be retired by that point. So your income tax liability will automatically be lower than it is today. Well, this is something that your PER provider is there to help you with. So from 5 years before your retirement, you can start to discuss and compare the different modalities of unblocking your money so that you can work out the most advantageous solution for you. Now, obviously, there's more detail, but those are the basics. And if your entitlement to a state pension is compromised, then you don't want to spend your golden years counting every penny. So start your research. MEA per 2024. I have no affiliation to any per providers at all. I just want you to have a comfortable retirement. If you haven't subscribed yet, then don't forget to do that, and I'll see you again very soon.